Let me show you exactly how I would start investing in 2025 if I had to begin from scratch. But first, we need to address why 90% of beginners lose money in the markets. And it's not what you think. After analyzing thousands of trades and spending countless hours researching market psychology, I've discovered that success isn't about picking the right stocks. It's about avoiding this one critical mistake that almost everyone makes: letting emotions control your investment decisions. In the next few minutes, I'll show you my complete strategy to beat the market. No hype, just proven methods. Here's a fact that changed my entire investment strategy. The S&P 500 has returned an average of 10% annually over the long term. But here's the shocking part. If you missed just the 10 best trading days in the past 20 years, your returns would be cut in half. That's why timing the market is a losing game. Look at this. A $10,000 investment in 2003 would be worth over $45,000 today if you simply stayed invested. The same amount trying to time the market usually ends up around $15,000 or less. Remember this: building wealth isn't about getting rich quick. It's about staying invested through market ups and downs. That's how real millionaires are made. Most investors panic when they see red in their portfolio, but here's what Wall Street doesn't tell you. Market corrections are actually normal and predictable. The S&P 500 typically has 3–5% drops every single year. Bigger drops of 10% happen almost like clockwork, once per year. And those scary 20% crashes? They show up roughly every 3.5 years. But here's the key. Each of these dips has historically been a buying opportunity. Think of it like this. Instead of seeing these drops as losses, smart investors see them as sales. When your favorite store has a 20% off sale, you don't panic. You buy more. The same logic applies to the stock market. Now let's get to the strategy I would use if I started investing today. The foundation of your portfolio should be a low-cost S&P 500 ETF. And there's a specific reason for this. This single investment gives you instant ownership in America's 500 largest companies. Think about it. You'll own pieces of Apple, Microsoft, Google, and hundreds more, all with a single purchase. The key is choosing the right ETF. You want one with annual fees under 0.1%. That's just $10 per year on a $10,000 investment. I personally recommend VOO or SPY. These are the largest, most liquid ETFs tracking the S&P 500. They automatically reinvest dividends, which means your money is constantly working to make more money. This is exactly how Warren Buffett recommends most Americans should invest. And it's what I would do with 80% of my starting capital in 2025. With your ETF foundation set, let's talk about individual stocks. I've developed a simple 3-part test for any stock I consider buying. First, the company needs to be a market leader in a growing industry. Think artificial intelligence, cloud computing, or renewable energy. Second, I look for strong management teams that own significant company shares themselves. They need to have skin in the game. Finally, and this is crucial, the company must have pricing power, meaning they can raise prices without losing customers. Tesla, Microsoft, and Apple all pass these tests. But here's the most important part. Never buy a stock just because someone recommends it. Instead, use these criteria to build a watch list of companies you understand and believe in. When market corrections hit, and they will, you'll know exactly which stocks to buy at a discount. Here's exactly how I would structure my portfolio if I started in 2025. When you're new, keep it simple. Put 80% in that S&P 500 ETF we discussed. and use the remaining 20% to buy individual stocks, but only after you've studied them using my 3-part test. As you gain confidence and experience over the next year or two, you can gradually shift this ratio. Many successful investors eventually move to 60% ETFs and 40% individual stocks. But here's the million-dollar secret. Never invest more than 5% of your portfolio in any single stock, no matter how confident you feel. I've seen too many portfolios destroyed by overconfidence. Remember, even the best investors in the world diversify their holdings. Let's wrap this up with the most important points you need to remember. First, don't try to time the market. History shows that consistent investing beats trying to predict tops and bottoms. Second, start with a strong foundation in broad market ETFs before diving into individual stocks. And third, align your portfolio allocation with your experience level. Now, while we've covered the basics of getting started in 2025, many of you have been asking how to accelerate your investment journey. If you're serious about building real wealth, check out my previous video on how I reached my first $100,000 on an average income. I break down exactly how I leveraged market corrections and used a hybrid investment approach to reach this milestone faster than I thought possible. The strategies I share in that video pair perfectly with what we discussed today, especially when it comes to balancing ETFs with individual stocks. You'll see how I applied these same principles to overcome the exact challenges you're probably facing right now. It's time to stop watching your money sit idle in a savings account and start making it work for you. That's all for today. Hit subscribe if you want more practical investment strategies, and I'll see you in the next one.